Let's talk about predetermined overhead rate. First, predetermined overhead is an annual rate a company estimates at the beginning of the year for allocating manufacturing overhead. So at the beginning of every year, a company estimates a rate that will be applied to manufacturing overhead. And bear in mind, manufacturing overhead is all indirect product cost. Okay, so manufacturing overhead is or are all indirect product cost. Okay, so any product cost that is indirect is considered manufacturing overhead because those things those costs cannot be traced directly. For example, a glue used in manufacturing, you can't trace it, you can't touch it. A supervisor's salary is considered indirect. Okay, supervisor in the factory is considered indirect because the supervisor doesn't offer a touch labor. The assembly workers are direct. They get direct cost. They consider as a direct cost because they offer touch labor. They can be physically traced. Okay, so that is the difference between or how to classify manufacturing overhead cost. All indirect manufacturing costs are considered as manufacturing overhead. Okay, now this is always estimated at the beginning of the year. So we have a company here, Ludacris Company, and this company makes furniture using a job costing. The following estimated were used in preparing predetermined overhead rate at the beginning of the year. But note here, the company's overhead cost product is based on machine hours. So we also have this term called cost driver. So the cost driver for manufacturing overhead is machine hours for this company. Okay, companies may use different cost drivers to compute manufacturing overhead. This use machine hours. Some companies may use different types of cost drivers or different cost driver, and we will talk about it in my next video for a company having different department and using different cost drivers. But here we will stick to the simplicity of it, which is machine hours, only one cost driver. This is the data in the beginning of the year, and this is actually happened. This is actually what happened in the following year. And we are required to compute the company's predetermined overhead rate. Okay, compute the company's predetermined overhead rate. Here I have prepared how to compute predetermined overhead rate. You'll remember in my previous video, I explained what total cost is. Okay, total cost, you remember y equal to a plus bx. Okay, a plus bx. Here I've replaced a with f, b with v, and x with h to make things easier. Okay, and very simple to understand. F represent the fixed cost, V variable cost, and H hours. Okay, predetermined overhead is estimated total manufacturing overhead cost, which is this divided by the hours. Okay, in a sense, F plus VH divided by H will give you the predetermined overhead. But note, this is for the previous years. That is why we have here this company at the beginning of the year. Okay, at the beginning of the year. So now let's go ahead and compute the predetermined overhead rate. We have been asked to compute this, the predetermined overhead rate. Okay. Now, computing predetermined overhead rate. As I've explained here, you first find the estimate total manufacturing overhead. But the estimated total manufacturing overhead consists of F plus VA, that is the fixed cost. Okay, what is the F here? Okay, so we have F, okay, which is the fixed cost. This is fixed manufacturing overhead cost that the company incurs. So fixed manufacturing overhead cost How much was it? $795,000. Okay. Variable. Open. Okay. The variable cost, variable manufacturing overhead cost was $1.4. With $1.4. The next one is the hours used. Okay. Hours. And here the cost driver for this company, the cost driver for this company is machine hours. So we use the machine hours there. Machine hours used is 75,000 hours. Okay, 75,000 hours. And there we get our estimated total manufacturing overhead cost, which will be, but first we multiply the variable manufacturing overhead cost with machine hours, as explained here, V times H. So we multiply these two, this times that, and we have the variable and the variable element here. So we need to get the variable element plus the fixed element. So this is the variable element. Underline it so easy to see. So we add the fixed element plus the variable element, and we have the total estimated to manufacturing overhead cost. So this is the total estimated manufacturing overhead cost here. Now we move forward. Because we have found this, we need to divide it by the H, by the hours allocated. Okay. Divided by the hours allocated. So total estimated overhead cost, which is 900,000, divided by the hours. Okay, estimated machine hours, that was 75,000. So we can just refer it here. And then we have here this divided by 75,000, we have $12. Okay, we have $12 here. So $12 per hour. So that means the predetermined overhead for the company was $12 per hour. Okay, so every hour of machine hours, predetermined overhead was $12. So in the coming year, or in this year, every hour of machine hours that was spent or that was used on the producing a product, a cost of $12 will be applied or allocated to it. So if they use 2 hours to produce a product or to manufacture something, $14 or $24 will be applied to it, because $12 is 1 hour. So every hour will be accumulated in the same step. Okay, let's go ahead. Now we have the predetermined overhead rate. Now we have been asked to compute the under-applied or over-applied overhead. Okay, under-applied, over-applied. So we know that at the beginning, the company has estimated that every 1 hour, the cost is $12. Every 1 hour, the cost is $12. But there's actual manufacturing overhead cost that was incurred during the year. Okay, so the company estimated this, and that is what happened. So you're going to compare the two, what we estimated and what happened. Okay, which one is more? Did we underestimate it or did we overestimate it? Okay, did you underestimate it? That's what called under-applied. Did we underestimate it or did we overestimate it? That's over-applied. Okay, so to compute that, we first need to use the predetermined overhead. Okay, so we find the predetermined overhead rate, which was $12, times the actual hours that was incurred. Okay, how many hours was incurred here? Okay, so we have the predetermined overhead because we assumed, okay, we assumed that every 1 hour the cost is $12. Okay, and here we spend 60,000 hours, so we multiply that by the $12. Okay, 60,000 hours will be multiplied by the $12, the actual machine hours, with 60,000 hours. Okay, and when we multiply it, the manufacturing overhead that was applied will be this $12 times the number of hours we spend on producing the product. So this is what we estimated. According to our estimate, manufacturing overhead cost should be 720,000. But was that what was actually the cost of manufacturing overhead? That's what we have to compare. Okay, we compare these two and we see if we underapplied or overapplied. Okay. Now, what was the actual manufacturing overhead cost? Okay, what was the actual manufacturing overhead cost that was incurred? We have here, in this year, manufacturing overhead cost was this, which was 850,000. So here, you know, straightforward that these two numbers are not equal. Okay, you can tell even without computing that these two numbers are not equal. We estimated 720,000. We have 850,000. That means, did we underapply or overapply? Did we underestimate or did we overestimate? Of course, we underestimate. Okay, so let's go ahead and compute this. We have here actual manufacturing cost was 850,000. Okay, so here we'll find the difference over applied cost under applied. Okay, we underestimate. Okay, so that is, we have this one minus the actual cost minus the predetermined overhead cost. Okay, so we, as a company, or the company, underestimated 130,000. That is a lot, pretty much. Okay, so the company, according to the predetermined overhead cost, estimated at 720,000 will be manufacturing overhead, but actual one was 850,000. That means the company underestimated 130,000 manufacturing cost. Good. Now let's move on to the third one. Assume that the company closes any underapplied or overapplied overhead cost directly to cost of goods sold. Okay, directly to cost of goods sold. Prepare appropriate journal entry. Okay, we know cost goes into cost of goods sold. Cost of manufacturing the thing, the product, goes into cost of goods sold. So the company cost of goods sold was this. Okay, but because it was under applied, the company is closing it, so cost of goods sold will actually have to increase by 130,000. And you have to do the journal entry for this. Okay, manufacturing overhead increases on the right, cost of goods sold increases on the left, the debit. Manufacturing overhead cost increases in credit. Okay, so we will go ahead and find and do the journal entry. So cost of goods sold, we know, was 130,000, will increase by 130,000. And then manufacturing overhead will increase by the same amount. So this is debit and credit issue we're dealing here. Know your debit and credit. So on the debit side, cost of goods sold will increase by 130,000, and on the credit side, manufacturing overhead will also increase by 130,000. Now, this takes us to question number 4. Question number 4. Okay. Assume that the company allocates any under applied or over applied. The key point here is allocate. Where was the word? Allocate. Okay, let me use this one. Allocate any underapplied to work in progress. So we have work in progress, we have finished goods, cost of goods sold on the basis of the amount overhead applied that remains. So the basis here, basis of the amount, okay, this is a percentage. You're going to use percentage to find the basis of the amount that was actually incurred. Okay. So we go back, okay. Here, work in progress, 36,000 was overhead cost, okay. We know we have 100,000 here, but 36,000 of it was overhead cost. Finished goods, 180,000 of it was overhead cost. So 36,000 was overhead cost. Okay, here 180,000 of finished goods was overhead cost, and cost of goods sold 504,000 was overhead cost. Okay, so we will add these together, will give us 100%, and we divide that, or we find the appropriate percentage of the total for each. Okay, so we'll begin by doing that first step, and then we will carry on from there. Okay. So we'll begin by having work in progress, manufacturing overhead, or overhead cost that was applied was 36,000. Finished goods, cost that was applied was 180,000. Cost of goods sold, 404,000. Okay, and then the total, we add all of them together, that will give us 720. Here we have 100%. So the total will be considered as 100%. Now we're going to find work in progress was the percentage of the total. Cost of goods sold was the percentage of the total. So we take this and divide by the total, which will give us 5%. And you can just drag it down. Oh, that doesn't work. So we would do 180,000 divided by 720,000. And we take 504,000 also divided by 720,000. So in total, we have 70%. Cost of goods sold was 70% of the 720,000 that was incurred. Finished goods was 25%. Work in progress was 5%. Okay. Now, now that we have computed this, we will use the same percentage to apply to 130,000. Okay, so 130,000 costs will be allocated instead of directly into cost of goods sold. So that means work in progress, 5% was the cost that will be allocated. 25% of 130,000 will be allocated for finished goods, and 70% of 130,000 will be allocated for cost of goods sold. So we'll do our T-chart again. I've already typed it out, so we just reveal it. Doing our T-chart again, we have our debit and credit. We have our debit and credit. Okay, and then credit here. So work in progress was 5%. So 5% times 130,000. That was 6,500 was the cost. Okay. We have 25% times. Okay, let's do it this way. Okay, let's put the 130,000 here. Manufacturing overhead cost was 130,000. Okay, so we're just bringing it down here, and then 5% times 130,000 will still give us 6,500. 25% times 130,000. This one 70% times 130,000. Okay. So using our T chart or T account, work in progress 6,500 will be allocated, 32,500 for finished goods and 91,000 for cost of goods sold if we allocated them instead of just applying them or closing them directly to cost of goods sold. So that's the number 4. Now let's finish with the number 5. How much higher or lower would net operating income if the under-applied or over-applied overhead is allocated rather than closed directly to cost of goods sold? Okay, goes directly to cost of goods sold. Now we know sales minus cost of goods sold. Let me here the process. Cost of goods sold is an expense. So sales minus cost of goods sold with any other expense will give us net operating income. Okay. So the question is, if we apply it directly, okay, versus allocating it, okay, how much would that affect net operating income? If we close it directly and allocating it, how much will that affect the cost of goods sold? The direct, or how much would that affect net operating income? So let me copy this and bring it here. Okay, let's assume we closing it directly. If we closing it directly, this is cost of goods sold. Okay, cost of goods sold at the end of the year was 1,400,000. Okay, so we have 1,400,000. Okay, this will get rid of it. This cost of goods sold T account. And when we close it directly, we added 130,000 to it. So we added 130,000 to it. So the balance of cost of goods sold will be 1,500,000, 530,000. Okay, so this will have been the balance if we did it directly. Okay, this is the balance if we did it directly. 1,500,000. Let me write here directly. If we did it directly. Now, if we allocated it, okay, if we allocated it, we will have 1,400,000 there because at the end of the year, the company has 1,400,000. But allocating it, we have only cost of goods sold of 91,000 here. Okay, when we did it directly, it was 130,000, but when we allocated, it was 91,000. So we had 91,000, and the balance would have been 1,491,000 for cost of goods sold. Now let's see the difference. Okay, you have been asked if you allocated, how higher or lower is allocated rather than closed. If we allocated it, we know that cost of goods sold would have been lower than applying it indirectly. Okay. So we find the difference, okay, with cost of goods sold. So we take this one minus the allocated one. Let me write allocating here, allocation here, allocation. Okay, so we have 39,000 as the difference. Okay, so that means when we did it directly, cost of goods sold was higher, so our net operating income was lower. When we allocated, cost of goods sold was lower, so our net operating income would have been higher by $39,000. Okay, so using allocation, net operating income will be higher by 39,000 higher, 9,000 higher. Okay, so the higher the cost of goods sold, the lower the net operating income. The lower the cost of goods sold, the higher the net operating income. So allocation gives us a lower cost of goods sold, which means our net operating income, or the company's net operating income, would have been $39,000 higher if manufacturing overhead cost is allocated instead of closing directly into cost of goods sold. That's the end of our video today. I hope this had been helpful.